The Supertrend indicator is a powerful tool for traders. Its primary function is to identify the direction of a market trend. Unlike more complex indicators, the Supertrend offers a clear visual representation of whether a market is in an uptrend or a downtrend. This simplicity is its greatest strength, making it accessible even to those new to technical analysis. Traders use it to make informed decisions, helping them to enter trades that align with the prevailing market momentum. It essentially filters out the noise of minor price fluctuations, allowing a trader to focus on the bigger picture and the dominant force driving the asset's price. The indicator is plotted directly on the price chart, making its signals immediate and easy to interpret in real time. Visually, the Supertrend indicator appears as a single line that trails the price either below or above it. The color of this line is the key to its interpretation. When the line is green and positioned below the price candles, it signals that the asset is in an uptrend. This suggests that buying pressure is dominant, and prices are likely to continue rising. Conversely, when the line turns red and moves above the price candles, it indicates a downtrend. This is a signal that selling pressure is in control, and the path of least resistance for the price is downwards. The indicator dynamically adjusts to price volatility, which is why it moves closer or further away from the price action over time. The calculation behind the Supertrend involves the average true range, or ATR, which is a popular measure of market volatility. The indicator uses the ATR to determine its distance from the price. The two main parameters you can adjust are the ATR period and the multiplier. The period sets the number of candles used to calculate the ATR, while the multiplier scales the ATR value to define the indicator's sensitivity. A larger multiplier creates a line further from the price, resulting in fewer but potentially more significant trading signals. A smaller multiplier brings the line closer, making it more responsive to price changes and generating more frequent signals, which could include more false alarms. Understanding why the Supertrend is so popular comes down to its dual purpose. It not only provides clear entry and exit signals but also serves as a dynamic trailing stop-loss level. When you are in a long position during a green Supertrend, the line itself can act as a floor for your trade. If the price breaks below this green line, it signals a potential trend reversal and a logical point to exit the trade to protect profits or limit losses. Similarly, in a short position, the red line acts as a ceiling. This built-in risk management feature is invaluable, as it helps traders stay in profitable trades longer and get out quickly when the trend weakens. Reading buy and sell signals from the Supertrend is straightforward. A buy signal occurs when the indicator flips from red to green and moves below the price. This crossover event suggests that the bearish momentum has ended and a new bullish trend is beginning. A prudent trader would wait for the candle that caused the flip to close before considering an entry. This confirmation helps to avoid acting on a false signal that might revert before the candle is complete. For example, if the Supertrend turns green, a trader might enter a long position at the opening of the next candle, anticipating further upward movement. The simplicity of this signal is what makes it a foundational strategy. Conversely, a sell signal is generated when the indicator changes from green to red and positions itself above the price. This indicates that the previous uptrend has lost its strength and a downtrend is likely taking hold. This is a cue for traders to consider either exiting any existing long positions or initiating a new short position. Just as with a buy signal, it is wise to wait for the candle to close to confirm the signal's validity. Acting too quickly on an intra-candle flip can lead to what is known as a whipsaw, where the indicator briefly changes color only to revert, trapping the impatient trader in a losing position. To enhance the reliability of these basic signals, many traders combine the Supertrend with other technical indicators. A common and effective combination is using it with a moving average, such as the 200-period exponential moving average, or EMA. The 200 EMA is often used as a long-term trend filter. A trader might decide to only take buy signals from the Supertrend when the price is trading above the 200 EMA. Similarly, they would only consider sell signals when the price is below it. This method helps to ensure that you are trading in the direction of the larger, more dominant trend, thereby filtering out weaker counter-trend signals. Another powerful confirmation tool is the Relative Strength Index, or RSI. The RSI measures the speed and change of price movements, identifying overbought and oversold conditions. A trader could look for a Supertrend buy signal and then check the RSI for confirmation. If the RSI is moving up from oversold territory, which is below 30, it strengthens the case for a long trade. For a sell signal, a trader might look for the RSI to be moving down from overbought levels, which is above 70. This confluence of signals from different types of indicators provides a much higher probability of a successful trade than relying on the supertrend alone. One advanced strategy involves using two supertrend indicators on the same chart, but with different settings. This is often called a dual supertrend strategy. The first supertrend is set to be more sensitive, with a shorter period and a smaller multiplier. For example, a period of 10 and a multiplier of 2. The second supertrend is configured to be less sensitive, with a longer period and a larger multiplier, such as a period of 20 and a multiplier of 4. The longer-term supertrend acts as the primary trend filter, while the shorter-term one provides the actual entry and exit signals, creating a more robust system for navigating the market. The entry rule for this dual strategy is quite specific. A trader would look to enter a long position only when both supertrend lines are green. The actual trigger for entry would be when the faster, more sensitive supertrend line flips to green, while the slower line is already green. This ensures you are entering on a pullback or consolidation within an established uptrend. For a short position, the logic is reversed. A trader would wait for both lines to be red, entering the trade when the faster line flips to red, while the slower one is already indicating a downtrend. This layered approach helps avoid premature entries against the dominant market force. The supertrend indicator is also exceptionally useful for trading breakouts. A breakout occurs when the price moves beyond a defined level of support or resistance, often with increased volume. The supertrend line itself can act as such a level. When the price has been in a sideways consolidation for some time, a decisive close above a red supertrend line can signal a powerful bullish breakout. Conversely, a sharp break below a green supertrend line can signal a bearish breakdown. Traders often look for a surge in volume to accompany the breakout, as this provides strong confirmation that the move has conviction behind it. The optimal settings for the supertrend indicator often depend on the trading style and the time frame being used. For day traders who operate on lower time frames like the 5-minute or 15-minute charts, more sensitive settings are generally preferred. A period of 10 and a multiplier between 1.5 and 2.5 can provide timely signals for short-term price moves. For swing traders, who hold positions for several days or weeks and use higher time frames like the 4-hour or daily chart, less sensitive settings are more appropriate. A longer period such as 20 or 21, combined with a larger multiplier of 3 or 4, will help filter out market noise and focus on the more significant trend swings. Effective risk management is non-negotiable for any trading strategy, and the supertrend is no exception. As mentioned, the indicator line itself provides an excellent guide for placing stop-loss orders. When entering a long trade after the indicator turns green, a logical place for your stop-loss is just below the green supertrend line. As the price moves up and the supertrend line follows it, you can manually trail your stop-loss along with the indicator. This technique allows you to lock in profits as the trade moves in your favor, while still giving the position room to breathe. The same principle applies in reverse for short trades, with the stop-loss placed just above the red line. It is crucial to recognize the market conditions where the supertrend performs best, and where it struggles. The indicator is, by its nature, a trend-following tool. Therefore, it excels in markets that are exhibiting clear directional moves, whether up or down. In these trending environments, it can generate highly profitable signals. However, its primary weakness becomes apparent in sideways or ranging markets. When the price is choppy and lacks clear direction, the supertrend will frequently flip back and forth between green and red, generating a series of false signals known as whipsaws. This can lead to numerous small losses that quickly erode a trader's capital. The benefits of the supertrend are clear. It provides an unambiguous, easy-to-follow signal for trend direction, entry points, and trailing stop-loss levels. Its visual clarity helps remove emotion and hesitation from trading decisions. The main limitation, however, is its lagging nature. Because it relies on past price data, specifically the ATR, its signals will always occur after a new trend has already begun. This means a trader will never catch the exact top or bottom of a move. The goal is not to be perfect, but to capture the majority of the trend, and traders must accept this inherent delay when using the system. Given these strengths and weaknesses, the importance of backtesting cannot be overstated. Before risking real money on any strategy involving the supertrend, you must test it on historical price data. Backtesting allows you to see how the indicator would have performed in various market conditions in the past. It helps you optimize the settings for your preferred asset and time frame, and it gives you a realistic expectation of the strategy's potential profitability and drawdown. This rigorous testing process builds confidence and discipline, which are the true cornerstones of long-term trading success. Never trade a system based on faith alone, always verify its performance through data.